In this video, we're going over problem 913, where we're looking at cost of retained earnings, or as we said before, the cost of common stock equity. So we're comparing, Amy Jolly is the treasurer, and she's looking at the cost of debt versus the cost of retained earnings, or common stock equity. And so she's thinking that she's thinking that the cost of debt will always be cheaper, will always be a cheaper option to finance the growth of her company. But when we plug in these numbers, we may or may not find out that she's correct. So we're going to do that in just a second. First, I just want to go over this idea that, this cost of debt versus cost of equity. And the general rule is the cost of debt can never be higher. I'm reading from this purple box right here. Can never be higher than the cost of equity, because equity holders will never accept a return on their investment that is lower than debt holders. This is because equity holders are always subordinate to debt holders and do not receive a contractual obligation to be repaid their capital. Okay, what they're saying is if you buy a bond, if you lend a firm money by buying their bonds, that's debt financing. They go in debt to you. Then you're guaranteed a return on that bond. You're guaranteed the value of the bond at some point in the future. If you invest in the stock of a company, they can retain the earnings, or they can return that in the form of dividends. And the other part of that is there's no guarantee that the price of the stock on the market is going to go up. It could always go down, and you could actually lose money. So that's why the expected return, or the return that investors want to think they're going to get on stock, always needs to be on investing in stock, on buying stock, always needs to be higher than if they were to buy bonds. And if it wasn't, they would never invest in stock. They would just buy bonds. So what incentivizes an investor to buy stock in the first place is the expectation of a higher return. So let's look at what these returns actually are. So before tax cost of debt, let's see, before tax cost of debt, the yield to maturity is 14%. So we put that right there, 14. The marginal tax rate is 30%. So we put that in there. So the before tax cost, or the after tax cost of debt, is 9.8%. And now let's calculate the cost of common stock equity. Let's see, the current market price is 39, so we'll put that in right there. The expected dividend per share, $1.50. And the expected growth rate is here it is, way up here, 4%. Okay, so we put that right here. All right, and we get a lower return on our stock than we do on our debt or on our retained earnings. So Amy is in this. If these numbers are correct, if the growth rate here projections are correct, if all of these are the correct numbers, then Amy's wrong, right? Correct? She is wrong. The correct answer is that she is wrong. Okay, so the question I'm asking you is, what variables would you need to increase or decrease, and by how much, in order for the cost of equity to be equal to the cost of debt? So what we have to change here in order to increase the cost of common stock, or another way to put that, increase the return that investors are going to get when they buy your stock. So if you look at the formula, you can see, well, this cost is going to go up, or KS, which is the cost of a common stock, okay, is going to go up if the dividend goes up, if the growth rate goes up, or if the current price of the stock goes down. So you can play around with this, and you can see what's going to happen. And I did this, and I just show you, and you guys can play around with this. But if you're watching the video, then you're going to have an advantage because you're going to see the answers that I've already found. But I want you to play with it. Plug something in. Just think about it, right? If the price of the share goes up, or actually goes down, well, that's going to mean that they're paying less to get more. So if you say we drop that to 29, see, you can see that brings up their return because the percentage that they get back is greater because their initial investment is lower. Let me put it back to 39. So I think I calculated these numbers over here. I said that if the expected dividend were to increase by 76 cents, or the stock price went down, and this is all ors, not and. This is if any one of these happened on their own in isolation, and the other variables were held where they are. So if you took any one of these in isolation, so if we took the price down to 25.85, or if we took the growth rate up to 5.95%, or the dividend were to go up to $2.26, any one of those three things would bring the cost of common stock equity up to be the same as the cost of debt. So let's just try one of them. So if we change the stock price to 25.85, so where are we here? Wrong one. We're here, right? So if we come right here and go up to, let's see, 25.85, 25.85. If we drop the price, then you can see that now that's going to be hard to do because that's really controlled by the market. So what would be more realistic would be to change the dividend, right? So we say, okay, we're going to give back more of a dividend per share, and I believe I calculated here that the dividend increased to $2.26 per share. That would do it. So let's just see. So we change the dividend per share to $2.26. That would do it. See, really close anyway. Very, very close. So so just play around, see if you can get the cost of common stock equity to be equal to the cost of the after-tax cost of a debt, and just type your answers in here, and that will take care of problem 913.